Welcome to my next edition of Technical Tuesdays. I'm very happy that our followers and viewers have requested a quick look over the head and shoulders pattern because we have two absolutely classic head and shoulders pattern developing, so it makes a nice live example. I like the live examples. It allows you to see how they develop and if my analysis is correct. So, head and shoulders, favourite pattern of mine, not easy to spot, but when the pattern is confirmed, it's quite reliable. The reversal pattern signals the end of a bull trend and a reversal into a bear trend. Why is that interesting? Because many signals can tell you that there is a strong chance of an end to a bull trend, but it doesn't actually mean that the market will reverse into a bear trend. What it can mean, or most likely means, is that the bull trend has reversed and we will move into a period of sideways consolidation, which may or may not then lead to a reversal in the price. But the head and shoulders is a bit more special than that because it does show a trend change. Now, the other major issue with the head and shoulders is it is so simple, and yet I see amateurs all over Twitter proclaiming to have spotted a fantastic head and shoulders pattern, and it simply is not. It's so simple and yet so misunderstood. Okay, so if you see the pattern forming in a sideways trend or on a bounce in a bear trend, this is not a head and shoulders pattern. So for example, you have to have seen a substantial bull move for this to be relevant and signal a reversal of the trend. If the bull move had started down here at around 113.00, 113.10 and managed to move up to a high here of 120.92, yeah, okay, that's a fairly decent 2-month run. But the head and shoulders pattern would not be relevant because the head and shoulders pattern has been built over a 3-month period. So you have to have a sustained bull run for the head and shoulders pattern to be relevant. And I see this mistake all the time on Twitter, and it really irritates me because people who read a textbook, been trading for a year, think they know it all, and start proclaiming to have spotted this super structure which is going to give huge potential profits, and they're just wrong. Anyway, this head and shoulders pattern in the euro US dollar is relevant, and I'm just going to remove that trend line. And it's relevant because we have had a serious bull move since the beginning of January in the euro versus the US dollar. In fact, since the 3rd of January, so pretty much the second trading day, we bottomed out at a low of 103.39. We had a very strong run up all the way up to 120.92 and have spent the last 3 months building this head and shoulders pattern. In fact, I spotted the potential around here on the right shoulder when we couldn't move above the 55-day moving average, and I was warning my subscribers very early on about the potential for this pattern to form. Anyway, you have to wait for the pattern to break below the neckline of the head and shoulders. So you get a left shoulder here, you get the head pattern, you get the right shoulder pattern. You can see it very clearly on this. What you do is you join up the troughs of the neckline of the shoulders, the troughs of the shoulders. You join them up to get the neckline, and there you go. There's your neckline. And this one's also quite interesting because look, we've got a shoulder, head, shoulder, a smaller head and shoulders pattern within the head, which is very interesting and does happen. Once the necklines of the head and shoulders has been broken, as it was on the 26th of October, this is your sell signal. It completes the head and shoulders pattern. Do not try and guess selling into the market ahead of the completion of the pattern in the hope that it will complete, because more often than not it won't complete. So that's just gambling. Wait until the head and shoulders pattern is complete and then look for your selling opportunity. Often the price will move a little bit below the trend line, the neckline, and then bounce back to the neckline to retest it, probably squeezing out a few weak shorts in the process. This is just textbook because see how the blue 100-day moving average has also acted as resistance around the same area of the neckline. So if you were selling it into the end of the week, you would have been getting into a very nice position. By Friday, the market tumbled again, and I do expect this price to continue lower now after the formation of the head and shoulders pattern. What's the measured target? You take the high 120.92, you take the low of the right shoulder 116.67, deduct that from 120.92, and you've got your target of around 430 pips from the neckline. So the neckline is at 116.71. You'll be looking at about 112.50, call it 112.40 as your target. That happens to tie in quite nicely with the 200-day moving average. So there you go. There's your measured target. Timing wise, I don't know how long it'll take there. It may not meet the measured target, but that's what you are looking for. Now, the fact that the pattern is a reversal pattern, meaning that there will be a direction reversal from a bull trend to a bear trend, means that not only could you hit the measured target, but you could continue lower and the bear trend could just develop. So bear that in mind as well. The inverse head and shoulders is the mirror image of the head and shoulders pattern, and this occurs at the end of a bear trend, a significant bear trend. Don't forget, not something that started around here and just moved down for a month or two, or after a period of sideways movement, then you get a little bit of an inverse head and shoulders. That doesn't count. It has to be at the end of a significant bear trend, which we have had since the beginning of January. This is almost a mirror image of the euro US dollar. I'm looking at the dollar index at the moment. The euro makes up a large part of the dollar index, so it's not surprising really that this is quite a mirror image of the chart you've just seen. Inverse head and shoulders, very simple. Left shoulder forms here, the head forms here, and again, look how we've got the mini head and shoulders pattern within the head pattern. You can look for that. That just reinforces the fact that this is a reversal pattern. And then we get the right shoulder here. We join up the two peaks of the shoulders to get the neckline, and bang. Once that has been broken, as it was very powerfully on the 26th of October, you have the completion of the inverse head and shoulders pattern, a mirror image of the head and shoulders pattern, which is bullish, indicating that a bull trend has started. Again, retest of the neckline very often happens. In this case, we've kind of been hovering above the neckline all week, but I do expect sooner rather than later for the price to accelerate to the upside and head towards the 200-day moving average as the price trend reverses into a bull trend. Measured target for the strategy for the pattern is, we take the low 91.01, the low of the head. We take the peak of the right shoulder, which is at 94.27. Deduct that from 91.01 from 94.26. Okay, so let's call it 3.2. We're looking at for 320 pips above the neckline. So we've got 94.34 as the neckline. We will be looking at 97.50 area as our target. So we should be looking for at least the 200 and then the 500-day moving average, and perhaps we can get a little bit further. We've done Fibonacci retracements in previous Technical Tuesday video analysis, and it's worth throwing it on there as well. And look at that, the 50% fib matches very closely to our measured target, so it ties in quite nicely with the moving averages and the Fibonacci's that we have mentioned before. Now, as I said at the start of the video, I'm very lucky to have these live examples of a perfect, almost symmetrical head and shoulders pattern develop, making my job nice and easy to record this video. But you have to note that the head and shoulders patterns do not necessarily form so symmetrically and so perfectly as they have done in this example. That can make spotting these patterns more difficult. So be aware that the shoulders, for example, shoulder here, they do not have to be the same size, the same shape, or even form over a similar time period. One could form over the period of a month, one could form over the period of 2 months. So they do not have to be sort of mirror images of each other. One can be significantly deeper than the other. If you see this example, you've got the right shoulder higher than the left shoulder. That's a little bit more positive. That helps to just reinforce the fact that this is a head and shoulders pattern. But there's no reason why the right shoulder couldn't bottom out down here. So yeah, just be aware that you're looking for lots of different formations of this pattern. Indeed, the neckline is nice and straight here, nice and horizontal. That doesn't even have to be the case in a head and shoulders pattern. I've seen many successful head and shoulders or inverse head and shoulders patterns with sloping necklines. So it's just something you're going to have to get used to. It does take practice and experience to get used to spotting this pattern, but it is worth the effort. In fact, having done this for 30 years, I've spotted many significant market tops and bottoms from the formation of head and shoulders and inverse head and shoulders patterns. In fact, I call the 2007 stock market crash and the 2011 mini crash just by spotting the head and shoulders patterns in the E-mini S&P. You might want to have a look at that now when you finish watching this video. Go and pull up those charts around the 2007 and 2011 for the E-mini S&P, and you'll see exactly what I'm talking about.